Good morning, friends. This side Rahul Magan here as a Group Chief Executive Officer, Treasury Consulting Group. Well, action is definitely going on. There is no doubt about the action. Chinese coronavirus definitely impacted the world stock exchanges. There is no doubt about that. If I speak about Europe, then it is down by over 12%, and if I speak about Dow and Nasdaq, it is down between 4 to 5%. When I'm speaking, it's already 2nd March 2020, practically 3:30 in the morning. Australian markets definitely opened up at that point of time. I'm sure that tomorrow would be another day of sell-off in the market. And expect that in this whole week, the exchange traded fund will continue to face the sell-off. And specifically talking the high yield exchange traded fund. Having said that, the one good news the world is having is that the managed accounts are not yet selling. So basically in exchange traded fund, there are two kind of people. One is the retail people and one is the managed account people. Retail people, you and me, who invest $500, $100, $1,000, $2,000, $10,000. Managed account people are those people, those who invest 25 million, 30 million, 50 million, maybe more than that. Whatever sell-off happened till now in stock markets, a major part of that sell-off contributed to the exchange traded funds. If these managed accounts who are currently not selling, rather they are waiting for the right point to come, if they start selling, then I might not be in doubt that the stock markets can correct it even by 25 or even more than 30%. But we don't know. We do not have that information. That level of information is always with the prime relationship managers of that banks who collate these information. So we don't have access to that level of information, but I am telling you that something is brimming in the managed account section, and probably they will wait for another 1 week or maximum 2 weeks, and then they will start selling. And once they start selling, I'm telling you, it would be a big mess off that would be on the cards. Having said that, today we're going to cover a mashup. Now in this mashup, we're going to be covering a lot of actions that has happened in the financial markets. But considering all what is happening, there I say that whatever is happening right now in the world financial market due to the Chinese coronavirus, a parallel market is also going on, and that parallel market is nothing but the interbank or the investment banking market. I'm not saying that volumes declined in the investment banking market. Investment banking, who used to be a physical meeting, now it is on WeChat, it is on ShareChat, WhatsApp Messenger, Skype and all. But one good thing which is happening is both DCM, which is debt and capital market investment bankers, and ECM, equity capital market investment bankers, they are not facing a sudden slip in the volumes of investment banking. So it is going on. But one biggest problem which is happening, and we're going to have a detailed video on that when the time would come, because we are collating the data, and until we have the data we don't speak much about the topic. But one bad thing which is happening is that majority of the action which is happening in the investment banking part, either it is AT1, additional tier 1, either it is in the form of the debt issuances, hybrid issuances, convertible bonds, convertible notes, convertible structures and all. Majority of the corporates, those who are entering into such kind of trades, they are more or less, high, basically non-investment grade players. So we define these people into three categories. One is the investment grade. One is the AAA rated. In fact, four. One is the AAA rated. Just like I was making a TikTok video today when I collated the data that Singapore, United States, United Kingdom and Hong Kong, They are the 4 AAA rated countries we have in the globe: Singapore, United States, United Kingdom, and Hong Kong. Even all the mess up that had happened in Hong Kong still is a AAA rated country. While India credit rating is triple B minus, on the contrary, China is much ahead than India, which is A plus. But unfortunately, the funding which is being raised nowadays in the investment banking market, and unfortunately or fortunately, all investment banks are helping companies to get this raise, is that they are high yield. Like I will not quote the name of a company, Chinese company, but I was reading and I got an information that one of the Chinese company recently raised around $250 million. And guys, you don't trust, they pay 9.8% in dollar terms. So on $250 million on a yearly note, they end up paying around $25 million only as an interest. 9.85 means practically 10%. Around $25 million is the interest, and they raise the funding for 5 years, which means only 125 million, 25 into 5, 125, 125 million is the interest component they need to pay in 5 years. 9.85%. And majority of the Chinese company, in fact Asian companies, they are raising money somewhere 5.3, 5.4 and all. I'm not going to quoting the name, but one of the leading renewable players in India recently tapped the dollar market by paying 6.5%. These high yields which being put up by the investment bankers are attracting the investors. If I am an investor, I am getting 10% yield on a dollar term, then I will definitely invest that. But one big mistake which is happening is that I do not understand that sooner or later this cycle will bust. Example, in 2008 and in fact in 2007, Greenspan, then central governor, never acknowledged that everything is wrong in the system. Even 2 days before, which is 11th September 2008, 2 to 3 days before, in one of the leading conferences in New York or Manhattan, somewhere in US, he said that there is nothing wrong in the banking system, and all of a sudden banking system collapsed. So today investment banking are getting their fees, no doubt, they are arranging the money, no doubt, but the final loss would be of the investor. Because an investor who is funding a Chinese company by only looking at 9.85% dollar return, he do not know that this Chinese company will not be able to pay that. His principal is at risk. So there is an action which is happening in the investment banking market. There is no doubt about that action, but we really need to continue to watch that action, and we need to see that till what extent investment bankers are able to either mitigate that risk or able to blot that risk. Like in 2008, they bloated that. End result, world financial crisis. If this risk will get blotted from here, probably another 2 to 3 years, then it would be a big mess off, and no one can stop that mess off. Now, in the mashup, I would like to cover multiple topics, and I would like to give my interpretation about the multiple topics. You know that whenever we make video, we will first collate the data. Until we collate the data, we never make the video. Number one, sovereign wealth funds of the globe, those who are facing lot of negative marketing in 2019 because of the interest, because of the dividend income they are earning, like Nordic, to whom I am going to talk today. Nordic Sovereign Wealth Fund, who is the largest sovereign wealth fund of the globe, and I think their AUM is over $1 trillion. They recorded negative interest rate in 2019, one of the quarters. And now they must be very happy, because in FICC, fixed income currencies and commodities, the C part, commodities, the another C part, currency, and the fixed income, they all are fluctuating. And I'm damn sure that sovereign wealth fund must be taking a bets on the equity. And since they are taking a bets on the equity, I expect that in March quarter, sovereign wealth fund will declare a bonus result. they will declare a fabulous result because markets are down and they are taking a reverse bet. They are taking a bet, the downside bet, and they would definitely be winning that. So this quarter we need to see how American banks and sovereign wealth fund will record their result, because FICC will definitely on the radar. There is no doubt about that. When it comes to Novarian Government Pension Fund, basically a sovereign wealth fund, they said that they are going to be betting on India around $9.4 billion, which is around $10 billion. And they increased their exposure to India by around 27%, and the total exposure of them in India is around 9.4%. I don't know whether you watched or not, Asian Investment Bank last week raised masala bonds. And if I tell you the yield they offered on a masala bond, you would be surprised. They offered around 6.6 or 6.7% yield on a masala bond. In this 6.7%, 6.7%, the exchange rate risk would be on the investor, because investor is investing in local currency while he is having some another currency. The withholding tax would be on the investor. So I always surprised that if any bank is offering a masala bond at 6.6% after deducting hedging cost, even in the non-deliverable market, how much you end up making. I really doubt. You don't end up making much, but investors are investing, because the big part of the market, which is Europe, it is negative interest rate policy. And now Tokyo, who registered around 6.3% contraction, which means negative GDP, 6.3%, they would definitely, the interest rate in the Japanese market will never be positive, that is for sure. So what is pushing that? The fact of that, the interest rate are going negative. Who is offering positive rate? People are investing. Just like kangaroo bonds. Kangaroo market is a market. Example, let's talk Formosa also. Formosa bond is a Taiwanese bond. It means that any foreign partner. So let's take an example, Apple. Apple will wanted to take the money from Taiwan. Please be note that Taiwanese insurance companies are very rich. They are cash rich companies. They are not like Indian life insurance and all. They wanted to invest their surplus money in a high liquid AAA rated bonds. So Formosa bonds is once again gaining momentum. So example, Apple want $1 billion, or take Blackstone. Blackstone want $1 billion. They hit the Taiwan market, Formosa. They offered 3.3 or 3.5% yield. For Taiwanese life insurance players, 3.5% yield is too much. They can even die for 3.5% yield. What they do, they heavily subscribe that. The book will swell by 2 times, 3 times, maybe more than 5 times. We don't know about that. Similarly, the case is the kangaroo bond market. When Australian government is inviting the non-Australian investors to raise their bond in the kangaroo market, in the Australian market, and take out the money. Because one thing we need to understand is that Australia is still one of the deepest bond market in the globe, if not the number one. Even after the bushfires, even after some political instability. So sovereign wealth fund across the globe are increasing their exposures in India and China. There is no doubt about that, and I got the data also. Now that data suggests that in 2013, around $10.8 billion worth of bonds being issued by onshore Chinese companies. 10.8, precisely 11 billion. 2014, this grew to 12.3 billion. In 2015, it grew to almost 17 billion dollars. In 2016, it reduced to 11.2. remember 2016 is a period of the trade war when the Donald Trump started the trade war. 2017 it grew to 26 billion, more than double, and in 2018 36.5, and now in 2020 is around 51 billion. It means that in 2013 to 2020, within 7 years period, the onshore bond market increased from around 11 billion to 51 billion, which means approximately 4.6 or 4.7 times. And this can only happen in China. But the media of India and the international media always give an image of the China, and people start feeling that, see, Chinese bond market are one of the deepest bond market we have in the globe now. Raising $51 billion only in the 2 months of 2020. Now the third month started of March. Only in the 2 months of 2020 is a fabulous job. No country in the whole globe can dare to raise $51 billion only in 2 months, and that too onshore. Specifically at the time when Chinese coronavirus is making a lot of impact across the globe. So sovereign wealth fund are raising their exposures in Indian market. But unfortunately, they also saying a contradictory thing, which is that the company, which is Nordic, the company also has 6 Indian fixed income investment worth 2.4 billion. This represents an increase in the fixed income investment which were worth 2.1 billion. The investment in India gave 6.6% rupee interest. So one thing I fail to understand when it comes to Nordic Sovereign Wealth Fund, number one, it's over $1 trillion fund. Number one. Out of $1 trillion fund, the total investment they made in India is around 10 billion. So 10 billion out of 1 trillion is nothing, is even not 0.5% of that. But the hype is created by Indian media. The Indian fixed income component out of this 10 billion is around 2.4 billion, which is around 24% is only fixed income component. And that fixed income component is generating 6.6%, and FX cost is on the sovereign wealth fund because they are investing their dollars in India, and dollar rupee USD INR exchange rate is on the novariant. So till what extent it makes sense, at least to me, I don't know, but media presented, let's like a Tata Group, media presented in such a way that everything is good as far as the sovereign wealth fund investment are concerned. And most importantly, we do not know that till what extent the another sovereign wealth fund are investing in Indian fixed income market. Example, Russia, Norway, we are talking about example Russia, Singapore, Saudi and others. So we don't have that information because we do not have an information of the consolidation, and even in case of Norway, around out of $1 trillion, the investment is just 10 billion, even not 0.5%. Rest you understand. Second important thing which I wanted to talk about is the Temasek. Temasek is in news for 2 reasons in the last 2 weeks. Number one, I don't know whether it is voluntarily or it is non-voluntarily, because on paper it is voluntarily. It is mentioned that Temasek, who is a sovereign wealth fund of Singapore holding over 300 billion plus asset as of now, is freezing the wage hikes, promotions or any kind of expenditure pertaining to that. More importantly, Temasek asked the senior management that they come voluntarily and take the pay cut up to 5% of their salaries. I fail to understand one thing. When you are a pension fund of $300 billion, no pension fund I heard till now who said that we're not going to be hiking the wage, we're not going to be giving promotions, we are asking senior management to come and scale down their salaries. You have Norway Sovereign Wealth Fund, Saudi Aramco, Saudi Investment Authority, Public Investment Fund. We have Qatar, Bahrain and many countries. I have never heard that this is the only time, first time I heard that Temasek did that. And they did earlier also. A $300 billion fund is doing such cheap activities is to saving the cost, which I don't think so is right. Anyways, the most important thing about Temasek is that Temasek is walking on a double-edged sword. Number one, everyone know that in DBS, Development Bank of Singapore, they are having a consolidated interest in Development Bank of Singapore, because DBS is a Singaporean based bank owned by government of Singapore, and Temasek is having a position in that. Temasek is eyeing on LVB Bank in India, which is Lakshmi Vilas Bank in India. Lakshmi Vilas Bank in India, and they are looking for a controlling stake of 51% or more in LVB Bank. One thing I fail to understand that I don't know, rather than doing an organic growth via DBS India, why are you buying a bank whose capital adequacy ratio is 1/3 of what the prescribed level? Example, see that. LVB capital adequacy ratio is around 3.5% as of December 2019. So your capital adequacy ratio is 3.5%, which is well below the regulatory level of 9%. I am interested to buying 51% stake using the government money. By the way, Temasek holding the government money, and government is getting the money from taxpayers. We are also a Singapore based company. They wanted to invest the taxpayer in a bank whose capital adequacy ratio is around 1/3 of the prescribed. This bank is on the verge of extinction, and they believe that if they merge this with DBS, then they would make it happen. And DBS also is not doing good. Let me give you numbers. It is understood that Temasek may initially rope in with its Indian banking unit DBS Bank India, a subsidiary of DBS Singapore, to acquire the stake in LVB. DBS Bank India was the first to remodel its operation as an Indian subsidiary in March 2019. In fiscal year 2019, they reported a net profit of 14.5 crores. Can you believe it? An Indian entity of a Singaporean bank recording a net profit of 15 crores. And especially when JP Morgan Chase India, an Indian entity of US Bank, when Goldman Sachs India, Indian entity of US Bank, Citi India, HSBC India, BNP Paribas, and the list is long, more or less all are playing in this market. So how do you term this? Would you term this holistic approach? Would you term this organic approach? Would you term this inorganic approach? If I am the head of Temasek, I would have never bought LVB. I would have made my Indian entity DBS more competitive. And by the way, DBS was in losses. This is the only profit they registered. So buying an LVB using the taxpayer money, if it will resolve DBS purpose, then I'm telling you that even after 5 years, it will never happen. Because I know DBS personally. So one thing I fail to understand on over and over basis is that the two sovereign wealth fund or the investment authorities of government of Singapore, which is GIC and which is Temasek, they both are taking that decisions which at least I doubt. Maybe you understand that very well, but I definitely doubt about that. Having said that, the biggest issue for me, if these decisions backfire, whose probability is higher, then Temasek will lose several hundred crores. And it will create a dent in Singapore, especially when the economy is about to grow 0.4%. And government himself acknowledged that a possible contraction is there up to 0.5%. So just think about it. Welcome to part second of this video, and in this video we are going to be talking about that how another stupidity by Reserve Bank of India create a mess up into the system. There is no doubt that Indian banking system is facing the worst crisis in the history, and this is bound to happen because the two important regulators of India, which is Security and Exchange Board of India and another is Reserve Bank of India, they both are doing horrible jobs. Because the biggest problem is that you are fixing the square peg in a round hole. So the square peg in a round hole means that there is a hole which is round in nature, and the peg which you are fixing is the square. So it will never be a complete combination. Henceforth, what happens, you are bound to lose. Recently, Reserve Bank of India came up with another circular which is on LCR, Liquidity Coverage Ratio Requirement for the Non-Banking Financial Corporation. Before I give comment on that, let me read it for you. The Reserve Bank of India on Monday introduced its liquidity management framework for a cash-strapped non-banking financial corporation, which means that RBI himself accept that liquidity that non-banking financial corporation in India is cash-strapped. The Apex Bank has said that non-banking financial corporation will now to maintain a liquidity buffer of high quality liquid asset to meet shortfall obligations so that they can survive. NBFCs with greater than 10,000 crores of asset, they need to maintain the LCR effective 1st December 2020. So all those who are, and this LCR will grow by 50%, grew by 100% in 2024. Which means that if your assets are greater than 10,000 crores, then you need to maintain 50% LCR. Come on, boss. There are multiple non-banking financial corporation or shadow banks, those who are having asset of more than 10,000 crores. 50% liquidity coverage ratio means that it's a high quality asset. It means that the total high quality asset divided by the total asset has to be more than 50%. Come on. Our financial market are living in a times when majority of the Indian corporates are having BBB minus credit rating. Although I am the same person who consistently coming in the public domain and saying that the credit rating given by these companies are absolutely pathetic and absolutely wrong, but still majority of the companies in India are having BBB minus credit rating. Then how can we go ahead with such kind of notification? And more importantly, if your asset size is between 5,000 to 10,000, then the LCR would be around 30%. I doubt that whether we can have 10% of LCR, 30% and 50% is a big mess. And in both the cases, the LCR will progressively increase to 100%. It means that by 2024, the 50% LCR would be 100%. It means that the whole 100% of the asset has to be liquid. Isn't that stupidity? Isn't that stupidity? You mean to say that a non-banking financial corporation in 2024 who is holding the asset side of more than 10,000 crores will have all liquid assets? India is a deep illiquid market of the globe. Everyone knows that. How can it possible that the 100% asset of a shadow bank oblique non-banking financial corporation would cover under LCR? This is height of stupidity. Literally, this is height of stupidity. And I don't know how a Reserve Bank of India monetary policy framework work, who all the people and what are their designations or what are their degrees, but before you draft such kind of stuff, it clearly suggests that you actually stand nowhere. You actually stand nowhere. Now, I would like to talk a very important talking about India, and I know that many people do not even know it about. But before this topic, we cannot discuss that topic until I give my congratulations to China. There are three things which are happening in China. Number one, the Chinese coronavirus, which is denting not only the Chinese economy but also the global economy. There is no doubt about that. Secondly, JP Morgan Chase, their leading JP Morgan Chase Emerging Market Index Bond Fund they approved the listing of onshore Chinese bonds into that bond index, which is fantastic. In Southeast Asia, even Singapore is not there. So you achieved. And here the credit has to go to the China. If everyone is blaming China about the virus, then they need to give that credit to China. So totally the story is that the Bloomberg Barclays index, who is much greater than JP Morgan by the way, they also accepted the onshore Chinese bonds. And according to the information we have in the public domain, that JP Morgan Chase will start listing the Chinese bonds effective 1st March 2020, which means yesterday. Yesterday was Sunday, so practically from today. And JP Morgan Chase said that by December 2020, which is around 10 months from here, around 10% of the bond index would be by Chinese bonds, which is phenomenal. That in an international bond index, which is used as a benchmark curve for pricing, which is used as a mark-to-market curve for pricing, 10% of that holding is by you. And more importantly, once we have the updated information about the statement by Bloomberg Barclays Index, we will definitely cover that. But China once again proved that in Southeast Asia, they are far better than any country in Southeast Asia. Even you compare Singapore with China in financial markets. This is phenomenal. This is phenomenal that a country who first listed its currency Chinese yuan in SDR, special drawing rights, the volume of the Chinese yuan grew substantially, CNH, offshore Chinese yuan grew substantially, and more importantly, the payments market of China is about to touch around $26 trillion, 26 trillion, which is about 80% more than Chinese GDP by 2023, which means that China as a country would have more, around 13 times the GDP of the India, only payments in 2023. And if I tell you about United States, then United States would be lesser than 1/3 of China in 2023. And United Kingdom stands nowhere. In 2023, the payment system in China would be more than $26 trillion, which would be, even United States do not stand 1/3 of that. And forget India. This is growth. Because they don't boast, they don't talk Paytm, Uber, PhonePe and all. They grew. Just to copycat, Indian government launched special series bonds. Before I give my judgment on that, let me read it for you. India is planning a massive debut issue of the special series government bonds, upward 10,000 crores. And approximately they said that this would be more than 10% of the gross borrowings of Government of India in this fiscal year. So fiscal year 2021, government would be borrowing 8,10,000 crores, and around 10% of that, which is 80,000 crores, would be the special series bond. Having said that, in a special series bond, how much crowding effect it will create, we do not know because we don't have time. But look at the fantasy. Some of the plan was spelled out by Finance Minister Nirmala Sitharaman in her 2020-21 Union Budget. Certain specific categories of the government securities would be opened fully to the non-resident Indians, apart from available to domestic investors. Some of the global bond indices that could embrace Indian government securities if all the conditions met, including the Bloomberg Barclays Global Aggregate Index, FTSE Russell, Asia Pacific, and JP Morgan Chase Emerging Government Bond Index. These indices have conditions which favor scale and size. For example, each issue should be $400 million at least. Come on. Can a government issue $400 million? Boss, $400 million US dollar at the rate of 70 rupees, standing around 2,800 crores. It means the single issue has to be 2,800 crores. Can government get this done? And there are another clauses also. And the total quantity should be at least 5 billion. 5 billion 35,000 crores. India is actually not India, Indian financial system, and specifically talk about Reserve Bank of India. We live in dreams. And I don't know how they make policy, what happens when they meet up in a meeting room to make policy, but they do not know that a country like China takes several years to list in JP Morgan, and within 10 months they would be around 10% of the index, and government is yet to issue social security this special series bond, and the government said it would be around 10% of the total issuances. The impact of crowding out we do not know as yet, because the borrowings is yet to start. But still, we make a fantasy that one day or sooner we would be a part of 3 top indices: JP Morgan Chase Bond Index, Bloomberg Barclays, and FTSE Russell. Come on. This can only happen in India. Nowhere else it happened. So with all this, I would like to give extreme congratulations to China. You did a wonderful job. And I wish as soon as the virus will resolve, China would again focus on the business and make RMB compete with US dollar. We got another information from India that between April to January, which is approximately a 9 months period, the fiscal deficit reaches 128% of the revised estimate. So fiscal deficit of government of India is absolutely beyond control and no one can stop that. Let's have a look. The central fiscal deficit for April to January is around 9.85 trillion, which is 128% of the revised estimate of 7.7. It means that last year that we estimate 7.7. The fiscal deficit end up 9.85. If I compare, which is 128%. If I compare the same numbers of last year, it was 121%. Even I would say breached fiscal deficit last year. We breached this year as well. But breaching of this year is far more than breaching of the last year. And still we believe that the market do not face any crowd out, by the way. Now let's talk the impact of the Chinese coronavirus here. Chinese coronavirus created lots of mess. Everything is down. Silver, zinc, nickel, crude, copper, lead, gold, aluminium, platinum, palladium. I don't want it to tell the numbers, but everything is down except for gold, platinum, palladium. They all are up, and diamond of course, because they are scarce commodities and they are used as hedging commodities or the natural hedging commodities. Having said that, the sell-off which is happening in the exchange traded fund market will continue. Managed account needs to watch very carefully. To cut this long discussion short, we feel that the global economy is facing a lot of recession this year. Job losses will definitely continue. And now I want to tell you something pretty tragic. World Quant and AQR are the 2 leading quant funds we have in this globe. And when we talk about AQR, one thing which I fail to understand is that they are having 29 offices across the globe. A $7 billion AUM company having around 29 offices across the globe. World Quant used to employ 700 plus people, while AQR used to employ around 900 plus people worldwide. World Quant is cutting around 130 plus people, and on the contrary, AQR is shutting down 5 offices and cutting 5 to 10% of the workforce. This is what both said in the public domain. What is outside public domain, what is happening inside, we don't know. But it would be more tragic than what's happening. What they said in the public domain. To cut this long discussion short, banks are firing people. Mutual funds are cutting jobs. Hedge funds are winding up. We're going to have a separate video about the hedge fund very soon. Private equity players are sitting on $2.5 trillion of dry powder. In the parlance of private equity, dry powder means that you have money but you don't know where to invest. So basically in private equity markets, dry powder is considered as a negative implication. It means that the higher the dry powder, the wrong for private equity. Which means that if your dry powder is higher, the sourcing avenues dried. So there is a fair limit of dry powder you need to maintain, but if that limit breaches, and that too on a permanent basis, it's a big mess off, by the way. So private equity is reaching higher side of the dry powder, which clearly means that the sourcing avenues are getting dried. Companies are into losses, so private equity player himself do not know where to invest. That is the reason they have started taking a call on the real estate, and that too aggressively. But that will also bounce, I will assure you. It is a matter of time. Quant funds, who are creating quant strategies and which they sell to hedge funds, institutional, pension funds, insurance underwriting and multiple companies, they are also cutting jobs. In case of World Quant, around 700 people and 130 people asked to step down, which means 20% of the workforce asked to step down. And this is what they acknowledged in the public domain. What's happening inside, neither you know nor I know. So to cut this long discussion short, the situation we have, or in the next 10 months, the situation would be worst, maybe more than worst. If the Chinese virus will continue from here in another 5 months, then delinquencies, bankruptcies may grow substantially. Maybe stock market will correct another 15-20% from here. Maybe every government need to copy the Hong Kong government formula of giving cash handout. I don't know. But the whole purpose of this mashup is that situation is bad. And the decisions which people are taking is also not correct. Till what extent these decisions will make impact in our lives in the financial market, doubt is always there. But let's see. With this, we definitely thank you very much. You know my mobile number, which is +91 9899242978. You know my alternate number, +91 9818485155. You know our fixed income platform, www.fixedincome.global. Thank you very much, and have a great time. At onset, we thank you very much for watching this video. The purpose of the Treasury Consulting Group YouTube channel is to spare a lot of knowledge, and that too practical knowledge in the public domain. We feel that the current education system in majority of the countries of the globe believes in degree, but we believes in knowledge. People often ask what Treasury Consulting does. Treasury Consulting is a Singapore multinational headquartered group wherein we currently have 3 legal entities, which is Singapore, India and Hong Kong. Eventually in this year we are planning a British entity and 2 OBRs, which is Overseas Bank Representative, which one in Germany, one in Greece tentatively. On knowledge front, we do offer a lot of stuff. We are having our fixed income platform, www.fixedincome.global, wherein around 62 plus live trading desks are there. And by December 2021, which is approximately 2 years from here, in a phased manner, about 100 plus, which is about 38 more will come. So in another 2 years, around 100 plus desks would be live. We do have around 200 plus training courses covering various topics which are available live on our fixed income platform. Currently we offer in 5 parts, which is functional trainings, forensic trainings, regulatory trainings, information technology trainings and technological trainings. More trainings are coming. Apart from that, we do offer MTM desk, which is mark to market of derivative, consultancy, project implementation, treasury management system, almost everything which we are coming, and more product domains are coming. On a knowledge basis, treasury consulting hold our hedge fund academy, which is 182nd platform. We hold our audiobook academy, which is known as audiobook. We are coming up with our OTT platform, which is over the top, which we titled as TRFX, and it would be completely different than we have Amazon and Netflix due respect to both companies. Our investment bank, hedge fund, it is also coming. More importantly, we operate 44 plus WhatsApp groups, and where we cover the books, the magazines, the bank research reports, I would say the GST, the corporate finance, the educational videos, the treasury, derivative, financial markets, synthetic derivative, and whatnot. All these 44 WhatsApp group are linked with the thread. So if a member of one group wanted to join another group, he can freely join that group. There is no. We do operate almost daily derivative email. You are welcome to join our group, but once again this group is subject to invitation and we will see your profile, we scrutinize your profile. So it is not for all, it is based upon the people, those who hold good profile. But if you have a fire in you and we see that you wanted to learn something different, we will definitely give you an opportunity to join. More importantly, my mobile numbers, which is +91 9899 242 978. My alternate number +91 9818 485 155. Both are in the public domain. They both are on WhatsApp. You are welcome to WhatsApp me at any point of time. Do not forget that we are the only platform when it comes to private placement, and there are so many things we are offering in private placement and many things which we are adding. Overall, Treasury Consulting is currently a Singapore multinational headquarter group, which would soon be London headquartered group, and Singapore would be Southeast Asia headquarter for Treasury Consulting. Our fixed income platform www.fixedincome.global cover a lot of information. We once again thank you very much for watching our videos, and we assure you that our both YouTube channels, which is Foreign Exchange Maverick Thinkers and which is Treasury X, and our TikTok channel would continue to grow. We are expecting around 6,000 plus videos only in 2020 and around 5,000 plus videos next year onwards on YouTube. And God willing, by 2020 December, we would be crossing hell lot of videos. Have a great time, and once again thank you very much. And our ambition of becoming or serving you or giving you a knowledge which books even do not give would continue. Have a great time.